Well, good morning. Welcome. This is the Patriot Radio News Hour. Joe and Jason. Joe was supposed to be back today, but his trip to Las Vegas, the KXXT conference, his son's college graduation did not end up happening in the timely fashion, so that would drug on a little later into the weekend, and then his trip into Las Vegas was delayed, and so it'll just be me covering the show again, like as I did on Friday. I covered a lot on KXXT coin on Friday. Just to take a look around here, because I got a long clip that I want to play for the majority of the show in between the commercial breaks, and it's I'll kind of go back and forth with the video, and just the nature of the banking system. How close to the edge are we? And if we're not close to the edge, what are they going to do to keep us from falling off the edge? Well, we'll cover a little bit of that. The number to call to buy gold and silver from the Patriot Trading Group, 800-951-0592. That number again is 800-951-0592. Gold and silver both down a little bit today. It's kind of taking back the gains from Friday. And I'm taking a look at the website. If you want to shop gold and silver and see more about what we are all about here at Patriot Trading Group, it's allamericangold.com. You can go to allamericangold.com and lots of articles. You just scroll down, and there's tons and tons of stuff talking about gold and silver, why we buy it, why we talk about it, why it's so important to be a part of your financial portfolio, and why you really need to have a good amount sitting in that account. But as I'm looking, taking a look at the shopping page here at allamericangold.com, we still have those $20 Liberties, $3,495. The sale was outstanding on Friday as Joe had gone on his trip. I decided with the gold, I think gold was up 65 bucks on Friday. I held that special even though gold was way up. Gold has not taken back all of those gains. It's down about $41 right now. So your cheap gold play right now is a $20 Liberty for $3,495. If you're at allamericangold.com, you can see all the prices of our silver and our gold. We have Silver Eagles at $805 a roll. I will put those on special today as well. You can buy rolls of Silver Eagles for $780. It's not reflected on the website. Joe usually handles the website in the morning, and we're probably shorthanded in the office in Arizona, but as many as you want, rolls of Silver Eagles, 20 ounces, 21-ounce Silver Eagles in the roll. The silver standard, I guess you would say. The U.S. Mint's been minting Silver Eagles since 1986. It's probably the most recognized 1-ounce silver coin minted across the world. And a roll of 20 is... Website has it at $805. I'll as many as you want at $780. You have to call 800-951-0592. I'm going to play. It's Carol Roth. It's with it's an interview that's being done with Jimmy Dore, and Jimmy Dore is podcaster and does shows, and he leans a little left, but he's kind of more libertarian. Doesn't really matter. He brought Carol Roth on. Those of you that might recognize Carol Roth, she does a lot of guests on other shows. She's on Glenn Beck a lot. But she's explaining a whole lot of what's getting ready to go down. She talks about the biggest U.S. bank, not the central bank, but the one that has 40% of all United States deposits, Bank of America, and how truly messed up that bank is. I'm thinking back in 2019, right before the old COVID thing got rolled into us and made the whole world shake in its boots. The repo market was falling apart. somebody, and the repo market is where overnight banking loans are. So if you're a bank and you got a whole bunch of extra deposits and less withdrawals, you're just fine. But the other bank might have way more withdrawals and not enough deposits, and so they do overnight lending, and it's usually pretty cheap. It's routine. But back in September and October of 2019, the repo market was falling apart. So there was an overnight interest charge of 10%. They won't tell you what bank or what banks, plural, were having this trouble, and it was bad. And the Fed came in and just fixed it, print, right? Just, same thing as in 2023 when Silicon Bank was having its troubles and folded very quickly. All of that's going to be covered in this piece. I'm going to play pretty much the majority of the interview. It's really good because Jimmy Dore definitely plays the I don't really understand this. So Carol Roth slowly tries to explain it. I think it's really good for the audience member that listens to Joe just ramble off the numbers. It's hard to keep up. It's going to be good. It's the supplementary ratio is going to be talked about. The changing of the regulations of banks of banking here coming up because these treasuries, trying to keep the borrowing for the government. You got to pay the bills. And nobody wants them. China doesn't want them. Japan doesn't want. The treasuries are selling them. Where are we going to stuff these things? Well, we're going to cover some of that ground with Carol Roth and Jimmy Dore in an interview that I'm going to bring to the air. Stay tuned. You're going to like it. 800-951-0592. Gold and silver, the Patriot Radio News Hour. I do want to remind people, we haven't talked much about it. We have and I've had some people ask me about it. We do have the metals program, and if you want to buy gold and silver and you don't really want to get all the details and try to figure out the different coins, once a quarter we put together, we make a buy of the cheapest metals there, and we put all the metals programs money together and make this purchase. And so you don't know exactly what you're going to get. What we buy is whatever's the cheapest metals we can get. It's a $100 minimum buy-in per month. You get charged once a month for 3 months. Really, that minimum, I'm going to talk to Joe about that. It's not very much in gold and silver anymore. We may up that minimum a little bit, but right now it's $100 per month. As big as you want to go. We have people that do $5,000 a month. At the end of the quarter, they get $15,000 in metals, and they don't have to think about it. We call you at the end of the quarter, and you come and pick it up. You're already paid for it because you've been charged for the 3 months worth of metals you've been buying, and that's how it works. You call the number over there in Arizona, and we will set you up with a metals program. That's Colorado or Arizona. You can, if you're listening anywhere outside of Colorado and Arizona, we'll ship this to you. But you call 800-951-0592. All right, Jack, let's go to this clip. This is Carol Roth with Jimmy Dore talking about U.S. Bank of America and its problems. $700 billion in low-interest loans bought during COVID, and the problems that poses, and we're going to listen to this because it really explains why the bond market pretty much is the indicator as to what's going to happen and how bad it's going to get in this country and even across the world. But, Jack, go ahead and start into this.
Carol Roth is with us. She's an American television personality, best-selling author, entrepreneur, radio host, and investor who has appeared as a guest on Fox Business, CNN, CNBC. She's one of the judges on Mark Burnett's America's Greatest Makers television show and is a weekly panelist on the current events and business show Bulls and Bears. What is she doing on this show? She authored the New York Times bestseller, The Entrepreneur Equation, and her latest book right here, You Will Own Nothing. You Will Own Nothing, Your War with the New Financial World Order and How to Fight Back. Here it is right there. Please welcome back to the show, Carol Roth. Hi, Carol. How are you?
Hey, Jimmy, I'm doing great. It's funny. I kind of feel like I always come here to talk about something depressing and financial instead of talking about like ice cream or puppy dogs or something.
Well,
so,
I go to someone else. I have a fat guy I go to when I talk about ice cream. But you look like you're right off your Red Shoe Diary shoot, and nice to see you as always.
Yes, thank you.
So the reason I wanted to bring you on, because I saw this disturbing bit of Bank of America is sitting on $700 billion in bonds bought at 1% yields in 2020. Those bonds are down 40%, hiding $100 billion in losses. Meanwhile, the Treasury needs to refinance. So let's listen to what this guy has to say. Who is this guy?
Porter Stansberry.
Okay. Oh, look! Thank God you know who that guy is. Here's what he has to say about this.
Our largest, most important financial institution today is Bank of America. Bank of America has something over $2 trillion in deposits. It has 40% of all the deposits in the United States. It is the banking system. Well, they invested almost $700 billion in bonds during the COVID summer, the summer of 2020, when long-term 30-year interest rates were at 1%. The value of those bonds has gone down almost in a straight line, and I think those bonds are now down something like 40%. Could be a little bit more now. I haven't seen the latest price. But the point is they're hiding enormous losses. They say those losses today, Bank of America has disclosed, there's something on the order of $100 billion. Okay, so if Trump destroys this recycling of U.S. debt that has gone on for 50 years, what that also means is he's destroying the ability of the Treasury to refinance. We've got $9 trillion worth of Treasuries to refinance this year, plus another roughly $2.5 trillion of new debt. So Treasury's got to go out and sell $11 trillion worth of Treasuries this year. I don't know how that's possible if Japan isn't buying, if China isn't buying. And by the way, not only are they not buying, the world's been selling our Treasuries on a net basis now for 3 or 4 years, and they've been buying gold instead. And so I think you can look at the price of gold versus the share price of Bank of America, and you can see something bad coming down the pipe.
So before I continue that, I just want to explain to people, because I didn't know I want to make it as easy to understand for someone as dumb as me. So when you buy a bond, they're also called T-bills, Treasury bills, right, Carol?
So it depends on the duration. If it's very short term, so up to, I believe it's a year,
we have
it's considered a
special
bill. If it's 2 years to 10 years, it's considered a note. And if it's over 10 years, it's considered a bond.
Oh, okay. So
Yes.
I thought, when the yield, meaning if I buy I'll get like an interest rate when I buy a bond, which is what a yield is. So I thought when that goes up, that's good. I thought that would be good news, because now more people are going to want to buy those bonds, because you're going to get more money back when you buy a Treasury bond. But that's actually a sign of economic weakness of the country. Could you explain why that is?
Okay, so I'm going to try and make this as easy to understand as possible. And by the way, they always make this opaque. They don't want any of us to understand this. So this is way overcomplicated. It depends if you hold your bond to the maturity date or if you resell it in the market. So let's say we want to invest in a T-bill for a year. We put $100 in. It says it's a 5% yield. Assuming that the U.S. government doesn't go bankrupt or default in the meantime, at the end of the year, you're going to get your $100 back, and you're going to get your 5% on that. So you're going to make $105, and you're going to say, fantastic, I made my 5%. That's great. What happens, though, is if you go into the market, if you want to do buying and selling and you don't want to hold that to that end maturity date, that 1 year point. And the best way I can have people think about it is think about a seesaw, because the bond's price and the yield trade in the inverse. So as we said, this was flat. This was our $100 and our 5% yield. It's fine if we hold it to maturity. But if we go in the market and we sell it, if that yield goes up, then on the seesaw, the bond's price goes down. The same thing happens on the inverse. If the bond's price goes up, then the yield goes down. And that's how I always remember it. I remember that seesaw. So when you think about what's happened over the past few years, we had this zero interest rate policy. There were very low yields. That's when everybody was buying these bonds, right? And so if there's low yields, it's a high price of the bond. So then the Fed raises the interest rates, and the yields to some extent follow. And so as the yields go up, what happens? That bond price goes down in the market if you're forced to sell it. Now, again, if you hold it to maturity, whether that's a year or 10 years or 30 years, it doesn't matter. You're going to get back with what it is that you expected in your yield. The problem is if you are forced to sell it. Does that help sort of explain the at least kind of backdrop here, Jim?
So it seems counterintuitive. If the money you're going to get back from buying a bond goes up, so if that meaning the yield goes up from 5%, say, to 6%, the price of it goes down. It would think to me that the price would go up because you're going to get more money for it.
So the yield is this. We're going to get really wonky here, but it's not just the interest rate, but it's the capital that you're getting back. And that's why there's a disconnect here in terms of the price of the bond and the yield. All you need to remember is that the bond prices and the yields trade in the inverse. Okay. And that's all that matters.
That's all that matters
to the discussion.
Okay. Right. And this is important because this guy is telling us that there's a big a possibility of a collapse of Bank of America coming, and I'll let him finish. I'll let him finish.
Because if there is a failed auction ever, or if the Fed has to come in and start buying again, which is what they will do, the inflation expectations are going to go crazy, and no one sees this. There will be a run on Bank of America, and there will be a day where the ATM machines do not work. And by the way, people say, "Oh, that could never happen." It happens all the time. Fractional reserve banking systems fail all the time. They're built to fail. And that's what happened in 1932. And, of course, what did the government do? The government seized all the gold in the country in 1933. So I see a clear set of circumstances, like I did with Fannie Mae and Freddie Mac, that to me, the numbers are crystal clear. What's different about America as opposed to Japan in 89 is Japan had like a 25% domestic savings rate. They had enough domestic savings that they could afford for their government to be 200% plus of GDP in debt. We can't because we have no domestic savings. Total domestic savings in the United States is less than $5 trillion. Less than. There's no way we can refi $11 trillion plus in bonds in 1 year because we don't have the domestic savings to do it, which means we depend on the kindness of strangers. And yet, what are we doing? We're pissing in those strangers' Cheerios. That is not good treasury management. And I'm telling you, this will happen this year. The Fed is going to have to go in to buy bonds again. And when that QE, quote unquote, starts again, the long-term yield on treasuries is going to go well above 6%. I think it'll go above 7%. Could easily go above 10%. Nobody sees that coming. Nobody's pricing Bank of America equity right now at 10% treasury yield. In fact, if you want to have some fun, go ask Grok. Hey, Grok, which is, XXAI, tell me what the situation looks like for Bank of America if Treasury yields go above 10%. How could the bank survive? There's a reason why the world's best informed investors.
Okay, so can you explain what? So he said that so people aren't buying Treasury. So he's saying so China is actually dumping their Treasury bonds, right? And he's saying that the other countries aren't buying them, so the Fed is going to have to go buy them. And that's going to raise the yield, which will lower the price of them, and that's bad. So is that? Am I close to what he's saying?
So that was a lot of information, and I feel like everyone's head probably is about to explode after listening to that. So there's kind of two pieces of this, and I'm happy to take it in whichever order you'd like. We can talk about the run on the bank and why, like what happened with Silicon Valley Bank, why that is potentially analogous or not analogous to Bank of America.
Talk about that.
So let's talk about that first, and then we can address the issues with the debt because they're definitely related, but they're two different issues, and he's sort of conflating a lot of different things that I think if we don't understand the basics, are going to be challenging. So if you remember back in 2023, we had a major banking crisis, and Silicon Valley and some others went bankrupt. There were bank runs, and the Fed had to step in to basically secure, quote unquote, the financial system. And so what had happened was that all of these people during the easy money times went and they deposited their money at the bank. And then, the bank said, okay, well, I need to do something with this money. Well, normally the bank makes loans, but if they don't have enough loans to make, then they want to put it into something that is quote unquote safe. And what do? They put it into these treasury bonds that we're talking about, as well as mortgage-backed securities in some cases. Now, the case with Silicon Valley Bank, what had happened was a couple of things. One is that when people decided that they wanted to get their money back because the rates started going up, maybe they wanted to invest in a treasury bond instead or a money market fund, or maybe their economic situation changed, all of a sudden Silicon Valley Bank was forced to sell some of these treasuries. And as we said, if you hold them to maturity, it's not a problem for Silicon Valley Bank. But if you're forced to sell them because people want their money back and you don't have that money back to give them without selling the treasuries, then you're selling at a loss. What happened?
Because the price of that bond has gone down.
Has gone down, exactly.
And if
Pause it there, Jack.
The rates went up.
For people trying to understand this, and we're going to play more of this coming out of the break. Very important what they just said, and then moving forward, what are they going to do? Bank of America has 40% of all deposits in this country, and they have this low interest debt that they bought during COVID, and it's losing value because if people start pulling their money out of Bank of America, because one, people don't have money, so they pull money out of the bank. Right, they need to pay the bills. They need to pay for this, pay for that, and then plus you got investors looking. It's like, wait a minute, this doesn't look too stable. And Silicon Valley Bank being a regional bank, this is what happened to them, and they folded inside a week. It was lightning fast. It was about a 2-week problem. It was probably was going on longer than that, but people started figuring it out, and they all started pulling their deposits. And they couldn't even make it through Friday to get to the weekend, and they were done. So what we're going to talk about in the next segment is what is the Fed going to do? What are they going to do? Because nobody wants this debt. So for Bank of America, they're going to have to discount this debt tremendously. It will break the bank just to try to keep up with depositors withdrawing their funds. So we'll join this on the other side. Stay with us. This is the Patriot Radio News Hour. 800-951-0592, the Patriot Trading Group. We have $20 Liberties on sale, gold and silver, $3,495. If you want to roll a Silver Eagles, that would be $780. It's not reflected at the website at allamericangold.com, but trust me, you can get those Silver Eagles live here and in Arizona for $780 a roll at 800-951-0592. We'll set up an appointment, get you all fixed up, and get you some protection from the stuff we're letting Carol Roth and Jimmy Dore talk about. We're going to get back into this video, the tremendously horrible problem, which will basically turn into a massive amount of inflation, as that's where it's going to end up. Jack, let's play some more of this.
Rates went up, so the bond price went down.
So the price that they paid for it, they're not going to recoup that money.
Correct.
And so that's where the loss comes in.
And that gets a loss and then compounded against their customers. So normally, if there's a little bit of that, it's not a big deal. What happened with Silicon Valley Bank is not only was their business model really focused on deposits. It was something like 90% of their liabilities were these deposits. And then of those liabilities, 93% of those, Jimmy, were not FDIC insured. So the people who had their money in the bank freaked out. They knew if, I'm not the first person in line, that all of these aren't insured and that money is at risk and that there's a potential loss. And there was a run on that bank, and that's what ended up bringing it down. So if you take that and you apply that to Bank of America, what is different about Bank of America, and I'm not saying it doesn't completely absolve them because they do have an insane amount of treasuries on their balance sheets, and there are a lot of issues with our financial system, and I'm not opining on that, but just so that people can understand the difference is that Bank of America has less of their liabilities and deposits. They have a more diversified business line, I think, compared to the 90% of Silicon Valley Bank. It's something like 70% of Bank of America. But they have far fewer of those accounts that are not FDIC insured. I think that their rate the last time I saw was under 40% versus 93% from Silicon Valley Bank. So, if you have that insurance, you're less concerned about, I have to pull this out, and there's less of a need to quote unquote make a run on the bank. So that creates a little bit of a difference. The other thing is that the Fed, if you remember, stepped in and they created this program to basically backstop the banks. Bank of America, is, as he said, the banking system. They own a piece of the New York Fed. I mean, they're entrenched into the system. So that the idea that the Fed wouldn't step in if something happened with Bank of America, which is less likely than Silicon Valley Bank, but certainly not, completely improbable. They're going to be more incentivized unless they want to collapse the entire system, and that's a whole separate discussion. So, could there be you're an ATM freeze at some point. Absolutely, there could be, but there could be because of a cyber attack. There could be because of an internal glitch. There could be for all kinds of reasons, including possibly a bank run. And that means for you as a listener, the way that you protect yourself is always having some cash on hand. Don't be in a situation where you don't have the ability to get you through several days without having cash. And the other thing, the big takeaway here is make sure you have insurance if you have a deposit. If you are with a traditional bank, it's FDIC. If you're with a credit union, it's NCUA. You want to make sure all of your deposits are insured, and you need to go to those financial institutions and ask them to make sure if something does go awry that you have that insurance in place.
Okay. And so
that's the first piece.
Okay, so he's saying Bank of America bought all these bonds at 1% yield, and now the yields are going up. So the price of those bonds that they bought are going down. So if they have to sell them, they're going to take a big hit. And he's claiming that their loss will be $100 billion potentially.
If they had to sell them. But again, unless they have everybody trying to pull their money out of the bank and they have less people, their business is less dependent on those deposits than other areas. They have wealth management. They have all kinds of other things that they do. It's a less likely of a scenario that they're going to be in a position where they're forced. The other thing that I will tell you, and this is a total cluster, is that the Treasury and the Fed, they're talking about deregulation for the banking system right now. There's something called the supplementary leverage ratio, SLR, is what you will see them refer it to. And it's basically a calculation of how much capital a bank needs to have on hand for it to be considered safe. They want to roll that back. They want to take away those protections, of course, so that, and this ties into the second piece, which we'll go over of what Porter was saying, so that the banks can actually buy more treasuries, because he is right. We don't have enough buyers of treasuries to finance and refinance our debt, which we can talk about. And so they want Bank of America to actually be able to buy more treasuries. So the likelihood is that they're going to find a way for that to happen, and to backstop it is the most likely outcome. It doesn't mean that the other outcome isn't a possibility, but from a probability, they are counting on that as a mechanism to buy our debt that nobody else wants.
Okay. Well, it sounds like you have two bad options, right? Right. So either you deregulate, which makes the bank more vulnerable to collapse, or if you don't, that means that no one's going to buy the treasury bonds, which means that the country's debt will overwhelm it. And so two bad scenarios. Either
the supplementary leverage ratio. I've talked about this last year, and how this is going to be where they're headed. To me, it's the most important part of this. That means Bank of America is not going to fail. They're going to be bailed out, but not bailed out like they were in 2008. It's always a new trick, right? Well, the United States wants the dollar to be used, and the government wants to keep spending into oblivion. It doesn't matter who's in charge. Trump, Biden, Obama, Bush, it doesn't matter. Spend, spend, spend. And the debt is getting out of control. He can't even pay the interest on the debt. But it is just a Ponzi scheme. It's just fraud. It's just made up. So the Fed can cook up a scheme which will make it easier for them to blame the big banks if something goes really wrong, which it will go wrong. It'll be inflation. And they're saying, look, nobody wants these treasuries, and we got this huge budget that needs to be passed. The next budget's going to be bigger than the next one, and we need to sell these bonds, these treasuries. Who's going to buy them? Well, if you got a big fat bank like Bank of America, who's going to lose $100 billion because they got these low-interest bonds that are worthless, they want to carry them to the end. That's how you make your money back on them. Well, how are you going to get all the deposits covered? Well, us at the Fed, we're going to let you just print up all the money you want. You print the money. But then you buy our treasuries that we need you to buy. We'll have more when you come back. Hey, we're going to deleverage the banks. I remember Bill Clinton, followed by Bush Jr., and they deleveraged the house. The way the banks could put these mortgage-backed securities together, relax the standards. We want everyone to have a house. And by 2008, the whole thing blew up. 2007, 2008, 2009, it's horrible. Just blew up completely, right? And then, of course, we just bailed everyone out by a bunch of printing, which has now led to an even deeper problem, and an even deeper problem. It just, at some point, there's going to be a day of reckoning at some point. But it looks like they have another plan to kick it down the road. There'll probably be some big recession or some emergency, some war will happen as they institute these new regulations, which is, Bank of America is essentially completely fraudulent and ready for default. But no, let's just let them print money. That's what they're going to deregulate the banks, which I'm not big on regulations, but if you set a certain, put together a set of rules, you should kind of stick to it. And then if you just leave it alone, everyone will play by those rules, but they keep changing the rules because those at the top really need to, in their minds, to control and own more, and they want to increase. They have their billionaire competition, who's got more. When you get that kind of wealth, there's really only one way to equate it, and that's against other billionaires, I suppose. But it's reindeer games going on at the top, and deregulate the banks. Bank of America and other big banks, they'll just print the money. You just print the money. But because we have this treasury problem, we can't sell enough treasuries, and the Fed doesn't want to buy them all, which is like eventually that's what's going to happen. You make sure when you print this money, you're buying treasuries at this higher rate. This will give you time to get rid of slowly but surely the maturity date on this lower rate, because we're no longer going to be in the era of lower rates. The rates are going to continue to climb over the next 30 years, like they did from the 40s to the 80s. From the 80s to 2020, 1980 to 2020, that we had slowly but surely the rates going down. Well, we are starting into probably a super cycle, 30 or 40 year cycle, where rates are going to continue to go up. Inflation and inflating their way out of this mess is the trick. It's as much as we like to make fun of the bankers and how they don't know what they're doing and out of control, they like that, because if we think they're foolish, then we don't take them seriously. They know exactly what they're doing. It's on the backs of the citizens, and we are going to pay for it. The printing of money by the big banks, because they'll be allowed to, buying the treasuries, which helps the United States government pay these ridiculous bills that they're stacking up, the debt that's out of control. And it will come to a day of reckoning, but it's a plan of inflation. Colorado passed some laws about price fixing. You heard Kamala Harris last year talk about price fixing. They're going to call it by different names. We'll control this inflation. We'll fix the prices. Well, you fix the prices, and then all the shelves go empty because no one's going to produce if they can't afford to produce. So we got some bad stuff coming down the pipe, and we'll just blame the big banks because they're so irresponsible. They printed all this money. Well, who gave them that? Who gave them that power? It's going to be the Fed and the United States government, and this is going to go on all over the world. All the banks are connected all over the world. This will happen all over the place. But Jack, let's play some more of this. We got a few minutes on this segment, and maybe we'll finish some on the last segment. Carol Roth talking to Jimmy Dore about how truly bad this situation is. Go ahead, Jack.
Talking about is the idea that we are basically on the verge of a debt crisis, which is something I think you and I have talked about before. I think pretty much everybody in the world has talked about this, although there's been no political will to actually do anything about it. They just like to talk about the fact that it's an issue. What he said is that we have all this debt that needs to be financed, and it's true, because what they did during the last administration is, because there aren't the buyers of our debt, he said central banks haven't been buying for the last few years. It's actually about the last 10 to 11 years on net. They have been net sellers versus buyers. And he's correct. They've been putting gold into their reserves instead of another country's currency. That we have all of this debt, and everybody who's left as a buyer, because they're not central banks who are just going to buy them to have them in their reserves, are now what we call price-sensitive buyers, that they care about the price, and they're demanding more yield, right? They want a higher interest rate, a higher coupon to hold on to it because, they say, well, I don't really trust the government. If I'm going to hold on to this for a long time, I have less confidence in it, so I'm going to demand more for the risk that I'm taking, which is supposed to be risk-free. And that's why you don't have the demand at these lower yields, and that ends up pushing the yields up higher. So we do have this issue, and what the past administration has been doing is that because there aren't enough people who want to buy a 10-year note, for example, they said, okay, well, we'll sell you a 30-day or a 60-day or a year. How about that? And we'll give you a nice interest rate on that. So there's been a lot of demand. In fact, Warren Buffett owns about 5% of what's called that short duration, the T-bill market, just collecting a coupon on that. There's a lot of short-term demand, but there isn't a lot of long-term demand. And the challenge is, because it expires in 30 days or a year, you have to refinance that every 30 days or a year. So you keep cycling that back into the market. And then we have our deficits. Well, we ran a $2 trillion deficit. We need to finance that as well. And because we have all of this supply that's going to the market and not enough demand, well, what does that do? That pushes down the price of the bond, and it pushes up the yields. And so that's what we're seeing over and over, and that's been the driver of what's been going on with the 10-year yield and why it keeps going higher and higher, why he's saying that it's likely to continue to go higher. The issue, which he says what happens at 6 or 10%, you don't even get there because the entire bond market basically dysfunctions and pukes all over itself, and we end up having things fall apart.
There you go, Jack. Good place to stop. One more segment here on the Patriot News Hour. Stay with us. We'll be right back. 800-951-0592, the Patriot Trading Group. We got $20 Liberties for $3,495. As you just heard, the buyers of treasuries are going to gold. It's happening all over the world. You can also get into silver if you don't have that much money today. You can get a roll of Silver Eagles for $780 at 800-951-0592. Jack, let's go. As you heard Carol coming into the break there, she's like, this goes right back to what Joe talks about. Joe's on the air. Been doing this for years. He's always giving you the bond prices, always telling you the 10-year bond. Carol Roth just said it. We just did the whole, the majority of the best part of this piece, which is it all comes down to these bond prices, and if they get pushed up to 5%, things blow up, and that is usually when quantitative easing happens. And this time, depending on where they stuff these dollars, it could be even more painfully inflative than what we just went through in the last couple of years. Hold on to your hats, and gold is inflation-proof. Gold is like a big shield against inflation. It's your best savings. It's the best way to hold whatever you've got sitting on the sidelines, trying to figure out what to do with it. Don't let it sit there for a long time in cash. You literally could have bought, back in 2019, if you had $100,000, you should have just spent it. Let's just say you had something you wanted to buy for $100,000. You should have bought it in 2019. Because here we are in 2025, and you can sparsely buy maybe 60%, $600,000. Your bank account says $100,000, but you can only buy about $600,000 worth of stuff. Maybe not even that. It's been moving. The inflation's been moving that quickly. You're going to want to get yourself into the savings of gold and silver, and that's what Patriot Trading Group does. 800-951-0592. Jack, let's play another minute or two of this as we're getting ready to finish the show.
So every time we get close to that range, and the range that usually sets it off is close to 5% on the 10-year. We're about 4.5, 4.6 right now. So as we get to 5%, it sets it off. Then the Fed or somebody else steps in, and they come in and they start buying bonds. We've seen this before with QE, or they come up with another cute name for the program so that they can say, okay, now we have more demand in the market, and then we're going to pull down the price of that yield. The challenge is for us is we know that's really inflationary. This is taking money from nowhere and putting it into the system, and it drives up inflation, and we end up paying the price for that. And so there are a lot of huge issues. There are a lot of ways, by the way, that the Treasury or the Fed can solve this in the short term. But the problem is, if we don't fix this, we're just going to continue to run into this into the long term until we have a full-blown crisis, because there's no more chances to fix it, or inflation goes, so high and gets so crazy, that we're all in like the Weimar Republic. So that's really the challenge here. And so it's somewhat related, in my opinion, to what he's talking about, but there's also just kind of a separate standalone issue with the debt. And when we talk about the interest that we're paying on the debt right now, we're paying over $1 trillion now for stuff we've already bought. If those yields go higher and we have to pay more to finance our debt, well, that explodes our deficit.
There we go.
And what did we just say about
Hey, guys, we'll have Joe tomorrow. We'll talk a little more about what's going on.